Remember, capital is king. Implications after the not a recession. Hi, everyone, and welcome to another episode of Insights brought to you by Ainsley Bullion and the Gold and Silver Standard. Today, we welcome back Alex, who's been completing another deep dive on the state of the global economy, particularly through the lens of the capital required to keep the whole system solvent against this backdrop of government debt and inflation. A lot to unpack. So how are you going today, Alex?
I'm going well, thank you. How are you?
I'm
Recovering.
I'm good. You've been through the wars recently, so thank you for soldiering on with us this morning. Let's begin by looking at what you're talking about in the news today. You use this term, a really interesting term of not a recession, and you've used it before, but I know when you say it, it's almost tongue in cheek. But let's start off by sort of exploring what you mean by that term and why it's important for everyone else to be in on that particular joke.
Well, I mean, how many more governments need to keep telling us we're not in a recession, but they're pumping up migration, they're doing all sorts of things. It's just a manipulation of numbers. So we're for the point of this just going to define not a recession as higher for longer, everything is fine over there. But in GDP per capita, we're probably in a recession, but definitely isn't a recession. So let's just, talk
A lot of
about what the
doublespeak.
numbers say. The numbers say something different, but because recession is measured in such a way, we're not in a recession.
Yeah, so it's one hand saying something, the other hand saying something else.
It's just
making
manipulation of numbers. And I'm pretty sure there was an article from Ainsley last week about how these numbers just are manipulated. We see revision after revision on the jobs numbers. 7 out of 9, I think, have been revised down. It's just a manipulation now to put us not in a recession when we are in a recession.
Absolutely, and that is what we were talking about last week, particularly this idea that you can't even really rely on those numbers now because the number that you get on the day is very different to the number that you get revised the month after. So
That's it.
it's a real issue. So we've got that idea that you've sort of highlighted there about it not being, they're not a recession, what that means in terms of manipulation. But let's look specifically about something you talked about, which was the M2 money supply. This is where it all gets a little bit technical, and I could argue that it's quite deliberately technical to make it difficult for the average person to understand, because at the end of the day, we really just talk about how much money there is in the system. But what's happening with the money supply, and why does this matter from your perspective?
All right, so money supply is basically M2 is measured cash deposits and other types of deposits that are readily convertible to cash. So, it's not your houses, they're not part of it. It is just readily available cash. The available cash in the US is 21 trillion. That's M2. The current debt in the US is 33.7 trillion, so 30% more, and it's increasing at about 700 billion every 6 weeks at the moment. So they keep spruiking this $2 trillion. That's all we're going to do in deficits, but I believe the numbers on tax receipts have fallen 500 billion now. 2 trillion is becoming like a fairy tale, just like it was this year. We're already at 3. We're not at the end of the year. They're saying 2 next year. It's not going to happen.
Because it's also an election year next year, let's not forget.
Yes, so why not spend your way to a win? So that's exactly what they're going to do. So 2 trillion is not reasonable. And let's say that we go to 4 trillion next year. So we hit the US debt peak at, say, 37 trillion is potential next year. It's nearly 2 times the total money supply. There is not enough money to pay it in any way, shape, or form anymore.
And the obvious conclusion out of that is that when there's not enough, more will be created.
Well, I mean, it's got to. So what's interesting is the bonds maturing next year out of the US. I've read 6 to 7 trillion. So let's call it 7 trillions maturing next year. We've just spoken about 3 to 4 minimum in a deficit out of the US. So we're sort of looking at about $10 trillion of bonds maturing next year, bonds needed to be raised by the Fed. Now, there was a heart attack about a week ago when $112 billion in 30-year bonds was sold, saw the yield spike. Well, we're now looking at 800 billion in auctions a month next year. Not only that, you've got Japan has started to become a net seller. China's a net seller. Saudi's a net seller. And in fact, Japan's dumping bonds now at the fastest pace it ever has. So we're now at 15 billion a month. So the US has to find $800 billion a month next year. Some of it is refinance, so it's, you can always roll those over. But there is just not the demand for it. The banks in the US are capped out. The other countries don't want to borrow of it anymore. There is going to be a huge problem for the US in the bond market next year.
And that point that you made about last week, I think a lot of people need to pause on that, because these things, we hear, there's news every day, there's stuff coming out, it's very quick that we forget what's just happened. But that could almost be a pivotal turning point in this whole discussion, because that could be where we saw everyone waits for something to break. That could have been the moment where something really broke quite badly, because that wasn't, we weren't in an extreme situation of they're expecting that to go quite smoothly, and it just didn't work. People did not want to buy that debt.
I'd argue the turning point was the glitch that wasn't the glitch. Remember that one when yields spiked? Like no one could understand how it was a glitch. Well, that was 2 months ago, and yields followed it up. And
I remember, because you were very quick on that one. You were sort of saying what's actually going on here, and then exactly, we just saw that the reality of that flow through, and it caught everyone off guard, but probably shouldn't have, because it's pretty logical, right?
Absolutely. And if 112 billion caused a huge issue last week, what is 800 billion going to do
right.
every month of next year?
7 plus times that. Crazy.
When you just have net sellers now. No, everyone's had it. I believe on 30-year treasuries, about 46% value's been lost for anyone who holds them, but they've had it. What's the point in holding it anymore? This is accelerating.
And I think historically people expect that you'll get that buyer come in because they'll see that there's a bargain there. But the fact that that's not happening tells you they're not seeing it as a bargain. They're seeing it as a real structural problem, which is what we've been talking about for a long time. Like it is a real structural problem. The market's sort of, or other countries or whoever's buying those bonds is waking up to that fact. And we're just not seeing people come in to buy it at a discount, because they're going, well, we don't want anything to do with it.
It's not a discount anymore, because the Fed is still talking about raising rates. Yields and spreads are still increasing. It is not a discount. Now, if this, 800 billion, if people have had enough and there are not enough buyers, there's no way the Fed can drop rates fast enough to fix the yield spread. So it's never going to be a bargain anymore. So people have to be seeing that.
Absolutely. So just changing track slightly, you specifically referenced transport in the news article today, and I thought that was really interesting. So how does transport relate to this idea that capital is king, this thesis that you've been putting forward?
So what I was trying to show, so M2 yields probably not going down, and that will stoke inflation, because you're going to have higher interest rates on any debt. So all of a sudden capital becomes king. We've spoken recently about all those zombie companies that are around. There are more and more that are coming through because, for the last 15 years, the way to grow a company was to have as much debt as possible, because it was 0%. You make more profit and you grow quickly. And in some ways, some of those capital companies, the ones that actually kept money, were punished for the thesis that that's what worked. But what is happening now, and I've heard it from quite a few banks in Australia, there's quite a few articles out of the US right now. There's been huge drops in freight worldwide. As you know, there's been increases in oil prices. So there's been a huge round of redundancy. So companies are getting rid of people because the demand's not there. We're now, I believe, under COVID rates for shipping, despite oil being significantly higher, which is interesting. The companies with money are buying, with capital, are buying these debt-destroyed companies, these zombie companies. So you've got this flow through right now of what is going to be a roll-up of monopolies. So in Australia, we all know what happens with monopolies. it stokes inflation. Meat prices drop, but Coles and Woolworths go, let's not pass it on for a little while. So it stokes inflation. So you've got these issues going on in the transport industry that are going to stoke inflation. And then the other part, which is why I picked transport of all the zombie sort of companies right now, is droughts. Panama Canal is done. So, the ships going through, they're waiting days. Suez Canal is a 10-day extra journey through, or you go all the way around South America. So that's extra oil, that's extra time. Now think about all of those shipping containers that are sitting on ships with goods that now cost 5% just to sit in the ships.
Yep.
That also increases inflation. So you're creating monopolies, you're creating supply chain shocks again, that are all going to stoke inflation. And we're just getting to a pretty strong breaking point at the moment.
I fully agree. So let's tie all that together under that banner of inflation, because that's really what you're talking about. What's your longer term view then? So around all this analysis you've given us today and taken us through, how does it all fit together under that inflation? What do we see happening in that longer term next?
So I guess Morgan Stanley came out yesterday, I think, and said that the Fed's going to drop rates rapidly. They're saying June next year, and everyone's saying, well, it's going to be sooner than that. What I'd be arguing right now is if they drop rates rapidly, which I suspect they will, yields are going to stay the same. We're going to see more monopolies. We're going to see more inflation from more interest costs. We're going to see more inflation just from shocks. I mean, a war, a drought, they're all supply shocks. I don't believe there's much to stop inflation anymore. You're damned if you do, damned if you don't.
And that is absolutely what we've been saying in many different ways over the last several months, that there really isn't a solution around this, because we've passed that point of no return. There's no solution. So it's just
But you'd actually argue that what the central banks have done by raising rates so rapidly, creating these monopolies, creating the cost of capital so high, that this is just actually going to make inflation worse. They've actually long-term made this a long-term structural problem that is near impossible to unwind.
And I think that's the real issue, isn't it? Because there is no easy solution. There arguably isn't a solution here, and that's not going to cause pain. So they're both, whichever way you go, it's going to cause pain. But the most painful method would be the one that really does slowly pull it back into line, and no one has the political will to do that. So it seems pretty straightforward.
Especially in an election year.
Yeah, that's right. So it's something that you maybe see in 2025. It's not a 2024 story at all.
No. So yeah, that's what I guess I'm trying to point out is I'm not sure how they get yields down anymore. And what they've done by creating zombie companies is they've created more monopolies. So that's not going to help inflation. And all the shocks that are happening in the world right now is creating inflation too. So where to from here?
Well, Alex, thank you for that. As always, it's great insight there and great depth of understanding that's really helps us all along this journey to understand what's happening, even if we can't control it. Hopefully we can take a little bit of advantage of knowing what realistically and logically is going to happen next. So really appreciate that. Thanks.
Oh, thanks for having me again.
Thanks everyone for watching. Remember, if you've got any questions or comments on, reach out on those social platforms and we take those on board. Thanks to everyone in Melbourne. Well, the last weekend we were at the Oz CryptoCon and a number of people came up and said hello. It was great to meet all of you. So appreciate that and appreciate you watching. That's us for today. We'll be back again tomorrow with BrainCode to discuss all things markets and metals. Until then, have a great rest of the day, everyone.